Let me tell you something that took me years of pain to finally understand. I used to believe that the only way to make real money in trading was to trade big. Bigger position sizes. Bigger risk. Bigger wins. I thought small trades were for small thinkers. I thought if I wanted a big life, I needed big trades. That belief nearly destroyed me. And if you are honest with yourself, there is a part of you that believes the same thing right now. You look at your account and you don't think, how can I protect this? You think, how can I grow this fast? And that one thought has quietly been bleeding your account for years. I know because it bled mine first. I remember sitting in front of my screen early in my career, staring at a perfect setup. Everything lined up. Trend, structure, entry. I felt it in my chest. My heart started beating faster. And instead of following my plan, I said to myself, this is it. This is the trade that will change everything. So I doubled my position size. Not because the edge improved, not because the probabilities changed, but because my emotions took control. And that single decision tells the whole story of why most traders fail. Because trading big feels powerful. Trading small feels boring. But profitable trading is not about feeling powerful. It is about staying alive long enough for probabilities to work. And I learned that lesson the hard way. In my early years, I wasn't really trading the market. I was trading my account balance. Every trade felt like a personal test of my intelligence. When I won big, I felt like a genius. When I lost big, I felt broken. My position size became a reflection of my self-worth. If I was confident, I traded big. If I wanted to recover losses, I traded even bigger. And slowly, quietly, I built a cycle that destroyed consistency. Big size created big emotions. Big emotions destroyed discipline. Destroyed discipline destroyed my edge. And I didn't even realize it was happening. Here is what most traders never see. The market does not pay you for being bold. It pays you for being consistent. The market does not reward confidence. It rewards discipline. And discipline becomes impossible when your risk is too large. Because the moment you trade big, your brain changes. You stop seeing setups. You start seeing money. You stop thinking in probabilities. You start thinking in hope. And hope is the most dangerous word in trading. When you trade big, every tick feels personal. If price moves against you, you don't think, this is just one trade in a series. You think, I cannot afford to be wrong. And the moment you cannot afford to be wrong, you are finished as a trader. Because trading is a business of being wrong regularly. Even the best traders in the world lose 40 to 50% of the time. But when your size is too big, every loss feels like a disaster. And when every loss feels like a disaster, your brain starts protecting your ego instead of your capital. You hesitate to enter. You move stop losses. You close winners early. You hold losers longer. Not because you are undisciplined, but because your nervous system is overwhelmed. You have placed yourself under psychological pressure that the human brain is not designed to handle. This is why trading big does not make you rich. It makes you unstable. I learned this after one of the worst periods of my career. I had a system that worked. I knew it worked. I had tested it. But my equity curve looked like a heartbeat monitor. Up, down, harder. I could not string together consistency. One day, after another emotional week, I finally asked the right question. Not, what is wrong with my strategy? But, what is wrong with the way I experience risk? That question changed everything. I realized my problem was not technical. It was psychological. My position size was too large for my mind. The risk I was taking was not compatible with emotional stability. So I did something that felt humiliating at the time. I cut my position size down to a level that almost felt pointless. So small that wins no longer excited me. So small that losses no longer hurt me. And something strange happened. For the first time in years, I felt calm while trading. I could follow my rules. I could let trades play out. I could accept losses without emotional damage. Nothing about the market changed. I changed. And for the first time, my equity curve became smooth. Not spectacular, not excitable. And stability is the foundation of all long-term success. Here is the paradox that confuses most traders. Small size grows accounts faster than big size, because small size allows consistency, and consistency compounds. Big size creates volatility, and volatility destroys compounding. You do not build wealth by making one huge trade. You build wealth by surviving thousands of ordinary trades. Think about it like this. If your risk is small enough, no single trade matters emotionally. And when no single trade matters, you are free. Free to follow your plan. Free to think in probabilities. Free to behave like a professional. And professionals do not try to get rich on one trade. They try to execute well over a large sample size. Trading small is not weakness. It is psychological intelligence. It means you understand that the real game is not prediction. The real game is self-control. Most traders blow up not because their strategy fails. They blow up because their size is too big for their psychology. They put themselves in a mental state where discipline becomes impossible, and then they blame the market. But the market did not break them. Their risk did. When you trade smaller, something powerful happens inside you. Losses become information instead of trauma. Wins become confirmation instead of relief. You stop needing the market to save you. You start letting the market pay you slowly. And slowly is how real money is made. I had to unlearn the fantasy that success in trading comes from boldness. It comes from patience. It comes from repetition. It comes from protecting your mental capital as carefully as your financial capital. Because once your mind is damaged, no strategy can save you. Trading smaller is not about making less money. It is about staying in the game long enough to let your edge work. Because the trader who survives always beats the trader who swings for glory. And the moment I finally accepted that, everything changed. Not my strategy, not the market, my relationship with risk. And that is when I stopped gambling and started trading like a professional. Big position size destroys psychological stability before it destroys your account. Let me take you back to the most expensive lesson of my career. Not the biggest loss in dollars, the biggest loss in understanding. Because what broke me as a trader was not a bad market. It was not a bad system. It was not bad luck. It was my position size. And for years, I didn't even know that was the real problem. Like most traders, I believed the myth that trading success comes from being bold. I believed confidence meant risking more. I believed that if I truly trusted my strategy, I should go bigger. I thought small size was for people who were unsure of themselves. So I traded big, and on the surface, it made sense. If I was right, I made more. If I was wrong, I lost more. Simple math. But trading is not a math problem, it is a psychological environment, and I was about to learn that the hard way. In the beginning, I thought my emotions came from the market. I thought price movement created fear and greed. I thought volatility was the problem. I was wrong. My emotions were not coming from the market. They were coming from my risk. Two traders can take the same trade, same entry, same stop, same target. One feels calm, the other feels terror. The difference is not the market. The difference is size. Risk is the volume knob on your emotions. Turn it up too high, and your mind cannot function normally. I remember a period where every trading day felt like a battle. I would sit down confident, prepared, ready to execute my plan. But the moment I entered a trade, everything changed. My heart rate increased. My breathing became shallow. My focus narrowed. The screen no longer showed price action. It showed money. Every tick against me felt like a threat, not to my account, to my identity. And once your brain perceives threat, it shifts into survival mode. This is biology, not weakness. Your brain is designed to protect you from danger, not to manage probabilities. When too much money is on the line, the brain does not care about long-term expectancy. It cares about immediate pain. And in that state, you cannot trade well. You become reactive instead of objective. This is where traders misunderstand discipline. They think discipline is a character trait. They think they lack willpower. In reality, they are placing themselves under a level of psychological pressure that makes discipline neurologically impossible. Try solving complex math while someone is screaming in your ear. That is what oversized risk does to your brain. The moment your risk is too large, the prefrontal cortex, the part responsible for rational decision-making, starts losing control. The emotional centers take over. This is not theory. It is how the brain works. And once this happens, your trading behavior changes automatically. You hesitate on good trades because you are afraid of pain. You jump into bad trades because you are afraid of missing out. You move stop losses because you cannot emotionally accept being wrong. You take profits early because you are afraid to lose what you have. You hold losers because closing them would confirm failure. Not because you are undisciplined, but because your nervous system is overwhelmed. Oversized risk creates a constant internal emergency, and you cannot run a business in a constant emergency state. This is why big position size destroys psychological stability before it destroys your account. Long before the blow up, something more dangerous happens. Your mind becomes damaged. You start associating trading with pain. Each trade carries emotional weight. You stop thinking clearly. And once your mind is unstable, the account is already dead. It just hasn't caught up yet. I learned this after reviewing years of my own trading. The pattern was obvious in hindsight. My worst mistakes never happened when my analysis was wrong. They happened when my emotions were high, and my emotions were high when my size was large. It wasn't the losing trades that hurt me. It was how I behaved after them. One loss would feel so intense that I needed to make it back immediately. So I would increase size, which made the next trade even more emotional, which led to another mistake. And suddenly I wasn't trading anymore. I was trying to repair emotional damage. This is how accounts really die, not from one big loss, but from a chain reaction of psychologically distorted decisions. And it all starts with size. Most traders believe they can handle it. They say, once I grow my account, I'll reduce risk. But psychology does not work that way. The brain does not adapt upward easily. If you cannot trade calmly at small size, you will not trade calmly at large size. Bigger money does not create emotional control. It exposes emotional weakness. Professional traders understand this deeply. They know their real edge is not their strategy. It is their mental stability. And they protect it ruthlessly. They size positions not based on what they want to make, but on what they can emotionally tolerate. Because once emotional stability is gone, performance collapses. This is why two traders with the same system can get opposite results. One uses a size that keeps him calm. The other uses a size that keeps him tense. Same system, same market, different psychology, different outcome. I eventually did something that felt humiliating at the time. I reduced my position size so much that profit seemed insignificant. And for a while my ego hated it. It said, "You should be making more than this." But something remarkable happened. I started executing perfectly. No hesitation, no impulse, no panic. Losses no longer damaged me emotionally. Wins no longer intoxicated me. For the first time I was thinking in probabilities instead of emotions. And that is when I finally understood. The problem was never my system. It was that my size had been too big for my mind. When you trade too large, you are not trading the market. You are fighting your own biology. And biology always wins. That is why most traders never become consistent. They are trying to perform precision work while emotionally overloaded. They think the solution is a better strategy. But the real solution is a better relationship with risk. Because until your risk is small enough to keep your mind stable, no strategy will ever work consistently. This is the hidden truth of trading. The market does not defeat most traders. Their own position size does. And once I finally understood that, I stopped trying to feel powerful in the market and started trying to feel neutral. That single shift changed everything. Trading big turns trading into an ego battle instead of a probability game. One of the hardest truths I ever had to accept as a trader was this. I wasn't trading the market, I was trading myself. For years, every trade I took was secretly a referendum on my intelligence, my discipline, my worth as a trader. If I won, I felt validated. If I lost, I felt exposed. And the bigger I traded, the more personal it became. At the time, I believed I was trying to make money. In reality, I was trying to prove something. And that is one of the most dangerous motivations you can bring into the market. Because the market is not a stage for your ego. It is a probability environment. It does not reward confidence, courage, or intelligence. It only rewards correct execution over time. But when you trade big, that truth becomes invisible. The moment size increases, the meaning of each trade changes. A small trade is just a trade. A big trade becomes a statement. It becomes a judgment. It becomes emotional. And once trading becomes emotional, objectivity disappears. I didn't realize this early in my career. I thought my emotional reactions were normal. I thought, of course I feel intense, this is real money. But intensity is exactly the problem. Professional performance in any field requires emotional neutrality. A surgeon cannot afford emotional swings during an operation. A pilot cannot afford ego in a storm. And a trader cannot afford emotional attachment to outcomes. But big size creates attachment automatically, because the more you risk, the more you identify with the result. Your brain links money to self-image. Win equals intelligence. Loss equals failure. And once this association forms, trading stops being a business. It becomes psychological combat. This is when traders start doing irrational things. Not because they are stupid, but because their ego is under threat. The ego does not care about long-term expectancy. It only cares about being right now. And this is where trading big becomes fatal. Because now every trade must win. Not financially, psychologically. And the moment you must win, you can no longer trade properly. You start protecting your self-image instead of your capital. This is when I began to notice a pattern in my own behavior. When I traded small, I followed my rules. When I traded big, I broke them. Same system, same knowledge, same experience. Different size, different behavior. That is when I finally understood something profound. Most trading mistakes are not technical. They are ego-driven. Revenge trading is not about money, it is about wounded pride. Overtrading is not about opportunity, it is about proving yourself. Holding losers is not about strategy. It is about refusing to accept being wrong. And taking profits early is not about discipline. It is about fear of losing validation. All of this is ego behavior, and ego becomes louder as size increases. Because the bigger the trade, the bigger the emotional meaning. When I traded big, a losing trade didn't feel like a normal business expense. It felt like humiliation, so I fought back. I tried to win it back immediately. And that is how traders turn one loss into 10. Not because they lack knowledge, but because their identity is entangled with their results. This is why so many intelligent people fail in trading. Not because they are incapable, but because they are too emotionally invested in being right. And big size intensifies this attachment. It magnifies the emotional weight of every outcome. It turns trading into a psychological battlefield, instead of a statistical process. This is why you often hear traders say, "I know what I should do, I just can't do it." That statement reveals everything. The problem is not knowledge, it is emotional interference. And emotional interference increases with size. Small size creates emotional distance. Big size creates emotional fusion. Distance allows clarity. Fusion creates distortion. This is why professional traders appear calm, not because they are fearless, but because they have structured their risk to remain emotionally neutral. They do not try to control emotions after they arise. They prevent emotional overload by controlling size. This is a critical distinction. Most traders try to fix psychology from the inside. Professionals fix it from the outside. They do not ask, how can I feel less? They ask, how can I risk less so feelings don't interfere? That shift is everything. When I reduced my position size, something unexpected happened. My need to be right faded. I no longer felt emotionally judged by the market. Losses became normal. Wins became ordinary. And for the first time, I could observe my trading without emotional distortion. I was no longer defending my identity. I was simply executing a process. That is when trading finally became a probability game instead of a personal drama. Because that is what successful trading really is. Not prediction. Not brilliance. Process execution in an uncertain environment. But you cannot execute a process when your ego is on the line. And big size puts your ego on the line every single trade. This is why traders with large accounts often trade smaller than beginners. They understand that emotional control is fragile. They understand that confidence is not built by risking more. It is built by performing well repeatedly. And repeated performance requires emotional neutrality, which requires appropriate size. The market does not care about your need to feel important. It does not care about your confidence. It does not care about your urgency. It only responds to probabilities, and probabilities only work over time. But time only works if you can stay objective, and objectivity disappears when ego takes over. That is why trading big quietly turns trading into a psychological struggle. Not against the market, against yourself. And that is a battle you cannot win. Because the market is infinite. Your emotional capital is not. Small size is what allows consistency, and consistency is what compounds money. There is a truth about trading that most people never fully accept, even after years in the market. Money is not made by being right. Money is not made by catching big moves. Money is not made by one great trade. Money is made by consistency. And consistency is not a technical skill. It is a psychological state. I didn't understand this early on. Like most traders, I was obsessed with outcomes. I wanted the big win. I wanted the trade that would erase weeks of effort in one moment. I believed that if I could just catch the right move, everything would change. But that mindset kept me trapped, because consistency does not come from intensity. It comes from repetition without emotional disruption. And repetition without emotional disruption is impossible if your size is too big. This is where most traders get confused. They think small size slows growth. In reality, big size destroys the very thing that creates growth, consistency. Think about what consistency actually means. It means executing the same behavior regardless of recent outcomes. It means taking the next trade the same way whether the last trade was a win or a loss. It means trusting your edge over a large sample size. That sounds simple. But emotionally, it is extremely difficult. And the difficulty does not come from the market. It comes from how much you are risking. When size is large, every trade carries emotional residue. A loss leaves fear, a win leaves excitement. Both distort the next decision. This is why traders cannot string together performance. They are constantly resetting emotionally, they are never neutral. And without neutrality, there is no consistency. Small size changes this completely. When you trade small enough, something powerful happens. You stop caring about individual outcomes. Not because you are disciplined, but because there is no emotional charge. Losses become routine, wins become routine, and routine is where consistency lives. This is the part traders don't want to hear. Boring trading is profitable trading. Exciting trading is usually losing trading. The market rewards dull execution, not emotional drama. When I finally reduced my size to a level that felt almost insignificant, I noticed something immediately. I stopped watching every tick. I stopped needing trades to work. I stopped feeling pressure. And because of that, I started executing flawlessly. I entered where I said I would. I exited where I planned. I accepted losses without argument. I let winners develop without interference. Not because I became more disciplined, but because my size allowed discipline to exist. This is a crucial insight. Discipline is not something you force. It is something you allow, and you allow it by managing risk properly. Once consistency appeared, something else followed naturally. A smooth equity curve, not explosive, not dramatic, but steady. And that is when compounding finally started working. Compounding is misunderstood by most traders. They think it comes from making more money. It actually comes from avoiding big drawdowns. A trader who makes 5% consistently without emotional disruption will outperform a trader who makes 50% occasionally and then gives it back. Because drawdowns interrupt compounding. And drawdowns are not caused by the market, they are caused by behavior. And behavior is distorted by oversized risk. Small size minimizes behavioral damage, which protects the equity curve, which allows compounding to work quietly in the background. This is how professional traders think. They do not ask, how much can I make today? They ask, how do I execute cleanly today? They know money is a byproduct of correct behavior over time. Not an event, consistency is the product, money is the result. But consistency requires emotional stability, and emotional stability requires small enough size. This is why traders who finally become profitable often say the same thing. I don't feel much when I trade anymore. That is not detachment. That is mastery. They have removed emotional interference. And they have done it not by controlling emotions, but by controlling risk. Small size allows you to see trades for what they really are. One event in a long series of probabilistic outcomes. Not a verdict on your future, not a test of your intelligence, not a moment of destiny, just one trade. And when trades are just trades, you can take them all. You don't skip winners out of fear. You don't force trades out of urgency. You don't abandon your edge during losing streaks. You stay consistent, and consistency is rare. That is why it is valuable. Most traders never experience true consistency because they never trade small enough to let it emerge. They are always emotionally reacting, always adjusting. And interference is the enemy of compounding. Compounding needs time and stability. It cannot work in chaos. Small size creates order. Big size creates chaos. This is why traders who survive long enough eventually reduce their risk. Not because they lack confidence, but because they understand what actually makes money. It is not aggression. It is precision. And precision requires calm, which requires appropriate size. When you trade small, you stop trying to force growth. You let growth happen. And growth that happens naturally is the only kind that lasts. This is the hidden secret behind long-term profitability. Not a better indicator, not a better setup, but the ability to execute the same behavior again and again without emotional distortion. And that ability is built on one foundation: small enough risk. Professional traders focus on survival first, profit second. The final lesson that separated everything before and everything after my trading career was this: amateurs focus on making money. Professionals focus on staying in the game. That one shift in perspective is the line between gambling and trading. For most of my early years, I was obsessed with profit. Every day I opened my platform thinking, how much can I make today? My attention was always on growth, speed, and results. I wanted progress now. I wanted proof now. I wanted the market to reward me quickly. That mindset felt logical, but it was deadly. Because when profit becomes the primary goal, survival becomes secondary. And in trading, anything that puts survival second eventually ends your career. The market is not a place where you get paid for ambition. It is a place where you get paid for longevity. I learned this only after watching many talented traders disappear. Smart people, hardworking people, skilled analysts, all gone. Not because they were wrong about the market, but because they could not survive its natural uncertainty. They were right often enough to win, but wrong violently enough to lose everything. This is when I finally understood something fundamental. Trading is not about winning. It is about not losing too much. If you protect the downside, the upside will take care of itself. But if you chase the upside, the downside will eventually destroy you. This is the inversion most traders never make. They think survival is passive and profit is active. In reality, survival is the most active skill in trading. It requires constant restraint, constant humility, constant respect for uncertainty. Professional traders wake up every day assuming they could be wrong. Amateurs wake up assuming they will be right. That difference in mindset shapes everything: position size, trade frequency, risk management, emotional control. Survival-first traders design their entire approach around durability. They ask, can I emotionally survive a losing streak? Can my account survive a drawdown? Can my psychology remain stable under pressure? Only after those questions are answered do they think about profit. Because they understand a brutal truth. You do not need brilliance to succeed in trading. You need durability. The market will eventually test you. Not once. Repeatedly, it will test your patience, your confidence, your identity, your discipline. And if your risk is too large, you will not survive those tests. Not because you are incapable, but because no human performs well under constant threat. This is why professional traders appear conservative. Not because they lack courage, but because they understand probability. They know that even the best edge experiences drawdowns. They know that no system avoids losing streaks. So they structure risk so that no streak can destroy them. They are not trying to conquer the market. They are trying to coexist with it. This is a radical shift in thinking. Most traders view trading as a battle. Professionals view it as a long-term relationship. And in any long-term relationship, survival matters more than intensity. When I finally accepted this, my entire approach changed. I stopped asking, how much can I make this month? And started asking, how do I ensure I am still trading next year? That question transformed my behavior. I reduced risk. I became selective. I stopped forcing trades. I stopped trying to recover losses quickly. And paradoxically, my profits became more stable. Not because I was trying harder, but because I was no longer trying to rush. This is the great illusion of trading. Trying to make money faster usually makes you lose it faster. Trying to protect your ability to trade makes money come naturally. Survival-first thinking removes desperation. And desperation is the root of most trading mistakes. When survival is secure, the mind becomes patient. When the mind is patient, execution becomes clean. When execution becomes clean, the edge can finally work. Professional traders are not obsessed with being right. They are obsessed with being solvent. They know that if they remain in the game, opportunities will come. But if they are forced out, no opportunity matters. That is why they trade smaller than they could. That is why they accept slow growth. That is why they respect uncertainty. They have learned what most traders never do. The goal of trading is not to win big, it is to not lose big. Because the trader who avoids catastrophe eventually outperforms the trader who seeks glory. This is why trading smaller is not conservative. It is intelligent. It is a long-term strategy in a profession where time is the true edge. Once I finally embraced survival as my primary objective, everything aligned. My psychology stabilized, my execution improved, my equity curve smoothed, not because I became more aggressive, but because I became more professional. And that is the final truth. The market does not reward intensity, it rewards endurance. And endurance begins with one simple principle: stay alive first. Everything else comes after.